let's make a start. Good morning. My name is Greg Einfeld, and I am the actuary and business owner at Lime Actuarial. I think most of you on the call, we already know each other, and most of you use our services, which is wonderful. We've had over 600 people register for this webinar. We're running the webinar today and then again on Wednesday, and over 400 people registered for this morning's session. So that shows that there is enormous interest in SMSF content generally, and particularly in ECPI. So I'm delighted to see that and really appreciate that so many of you have trusted in me in terms of delivering this content to you. The pressure's now on, and I hope I don't let you down. As I said, most of you are very familiar with Lime Actuarial. For the small number that aren't, and while we just wait for a few more stragglers to arrive, why is it that most of our clients use Lime Actuarial? Well, from what they tell me, it's a combination of things. We've been providing actuarial certificates for SMSFs for 9 years now. Our turnaround time is literally instantaneous. About 98% of the time, it will be 5 to 10 seconds. Our certificates are great value at over only $100 plus GST, and that's less than the majority of our competitors. We're integrated with Class Super and with BGL 360. And for those of you that don't use either of those, we have a really easy to use web interface as well. And in addition, we're working on some further integrations as we speak. And then if you have any technical questions, you can call up and speak to the business owner and the actuary in the business. And not all of the actuarial providers offer that. And of course, when you do speak to that owner or business actuary, that will be me. But of course, you didn't come here today to hear me advertise. You came to learn about ECPI. So why don't we move straight into that? Just as far as some logistics are concerned, so questions, feel free to ask any questions as we go along. And I'll stop from time to time and I'll answer all the questions that have come through. And then there'll be plenty of time at the end for questions as well. So just put the questions in the Q&A box and I'll do my best to answer them. And I've had a couple of questions that have been submitted in advance too. Okay, so the topics, the content that we are going to cover today, I'll do a brief introduction, and then we're going to talk about segregation, what it is, how it's changed in 2022, and the choices that you will need to make in conjunction with your clients in relation to segregation from this point onwards. We'll talk about disregarded small fund assets. That concept has been around for about 5 years now. It's changed a little bit though, so we'll talk about that as well. And then we'll move on to the tax implications of the choices that you're going to make and what's going to give you and your clients the best tax outcome. And then we'll talk about the mechanics, once you've made that choice, how you go about exercising it. And then we'll wrap up at the end. And as I said, plenty of opportunity for questions as we go through. Just going to check if there's any questions at this point. I've had a question from Bill. Will there be a recording of this webinar sent to us later? Yes, there will. So I will be sending out a recording. Probably I'll get it out to you by the end of next week. So if you haven't got it by then please be patient. Oh, gone a bit fast there. Yeah, just please be patient if you haven't got the recording by the end of next week. My intention is to get it to you by then. And I've had another question at this point from Vicky. Does Lime provide the percentage automatically confirmed and sent to Simple Fund? Yes, absolutely. That's part of our integration with both Class Super and with BGL Simple Fund, that we automatically prepare our certificate. Only takes a few seconds, and the ECPI result is sent straight back to Class or BGL, whichever software you're using. The certificate goes to them as well. We email it to you in addition to that. And we have a website dashboard where you can log in and see what all your past certificates and invoices too. So there's lots of different ways that you can see the certificate and the ECPI. Okay, let's get into our first topic for today. Oh, I keep getting more and more questions here. Here we go. Okay, next question. Using class software, sometimes the percentage allocation of expenses doesn't agree with the actuarial certificates. Why? Okay, that question I'm going to come back to at the end. I don't want to get too bogged down for the moment in questions that don't specifically relate to the topic. So I'm going to come back to this question about why is it that expense allocation percentage doesn't equal the ECPI percentage. Okay. Okay, and then Vicky's making a few comments. Vicky, I'm going to take that offline with you because once again, I don't want to get bogged down at this point in time. Okay, now we're going to talk about segregation and choice. Okay, I really like this quote here from Wayne Dwyer. Wayne is known as the father of motivation. So he was a motivational speaker. And he said, "You are doomed to make choices. This is life's greatest paradox." In other words, whether you like it or not, you don't have a choice. There will be times that you need to make choices. And that's the paradox. You can't choose not to make a choice. I really like that. And I think that's really apt in terms of what we are discussing today. So I want to take you back in history. I'd like to go back to the year 2017. And you'll remember that there were changes that came in 2017. There were 3 different changes that affected the way that we calculate ECPI that went back to 2017. So let's run through those. The first one from 2017, TRIS pension income is no longer exempt. So that changed in 2017. You might remember prior to that, the income from TRISs was exempt from tax. The second one, from 2017 onwards, actuarial certificate ECPI calculations only cover periods where assets are unsegregated. So in the past, our calculations would look across the whole year and we give you 1% that applied across the whole year. Now we split the year into the periods where assets are segregated and the periods where assets are unsegregated. It's created additional complexity. And it's this complexity that Treasury thought that they would try and reduce. And that's a large part of today's conversation. And then thirdly, there was this new concept introduced called disregarded small fund assets. And if you have these assets, then all of the assets in the fund are deemed to be unsegregated. Okay, and we'll talk more about what disregarded small fund assets are a bit later in the presentation. So those were the changes that we had in 2017-18. Now for today, we're going to focus on these 2 because these 2 have both changed for the 2022 year. Okay, and a lot of you are just starting to prepare actuarial certificates now for the 2022 year, and that's why we're running this webinar today. Okay, and so you need to be aware of how these 2 changes that took place in 2017 have now changed again in 2022. Okay, so there's a bit of an introduction. I'll just see if we've got any new questions here? Okay. No new questions. Let's move on to this next section, which is called disregarded small fund assets. Now, this is the first example we're going to talk about today. This is a fund that has $1 million at the start of the year, for the first half of the year, all in accumulation. And then on the 1st of January, it looks like the member or the members have started account-based pensions. They've moved all of their balances into an account-based pension. And now, for the second half, there's $1 million in pension. I think that's a fairly standard scenario. This format, the way I've drawn this scenario, I'd just like to make sure you follow the format, because I'll be using the same format for lots of examples today. So the light blue is accumulation and the dark blue is account-based pension. And I've shown there the periods where the assets are considered by the legislation to be unsegregated for the first half of the year and segregated for the second half of the year. So when all of the balances are in account-based pension and there's no accumulation and there's no TRIS, the assets are deemed to be segregated. Okay, so that's the scenario here. I hope everyone understands that scenario. It's fairly straightforward because we're going to need to understand that in order to consider the changes going forward. Okay, so keep that scenario in your minds. So let's look at how we would have treated this in 3 different time periods. Up until 2016-17, actuaries would calculate here a single ECPI percentage, which would be applied for the entire year. Okay, sometimes we forget that that's how it used to work, but that is how it used to work. And often I get questions to this day where some accountants still think that it still works that way. Okay, so that's how it worked up until 2016-17. Then from 17-18 until 2021, everything changed. And we had to separate the year into the periods where the assets were segregated and the periods where the assets were unsegregated. And we would only calculate ECPI, we being actuaries, for the unsegregated periods. For the periods where the assets were segregated, the ECPI would be 100%. And your accounting software, if you're using, let's say, Class Super or BGL, your accounting software will do that calculation for you of the 100%. But it won't calculate the ECPI for you. That's where you need the actuarial certificate. Okay, so hopefully you've all got a good grasp on what changed between 16-17 and then 17-18 onwards. Now, when this changed back in 17-18, a lot of us in the industry, certainly all of the actuaries and many accountants and industry associations, complained to the tax office and to Treasury about the way this changed. And we said, this is adding a lot more complexity. And so Treasury said, well, then we're going to simplify it for you. And we were all hoping that they would simplify it by going back to the way it was in 16-17, because that's, I think, the most intuitive method and it's what everybody understood. But no, they didn't do that. What they said was that from 21-22 onwards, we would have choice. So the trustees could choose which of these 2 methods they use. Did they want to use the proportionate method, which is the prior to 16-17 method, or do they want to use the segregated method, which is the 17-18 to 20-21 method? So that's the choice that is now available to you. Okay, let's look at an example. This is the same example I put up before, so you should all be familiar with it. Okay, so how would actuaries have calculated the ECPI for this fund in different periods? Well, up until 1617, we would have said that for about half the year, the balance is in accumulation, and for about half the year, the balance is in account-based pension. And we have to calculate one ECPI percentage that covers the whole year. So we're going to calculate 50% exempt. That's how it worked back in 1617 and prior to that, for many, many years prior, for as long as superannuation existed prior. That's how we did it. Okay. Now, if we had prepared a certificate for this very same fund for the 1718 to 2021 years, we would have said 0% exempt, because we would have split the fund into 2 years. We would have said 2 periods, I should say. For the first 6 months, that's the period where the assets are unsegregated. So that's the period where we are calculating ECPI. And we would have said in that period, everything's in accumulation. So the ECPI percentage is 0. We wouldn't have calculated the ECPI for the second half. Your accounting software would have done that for you. Or if you're doing it manually and you were familiar with how this worked, you would have done it yourself. So you would have got 2 very different percentages appearing on your actuarial certificate, depending what financial year your certificate related to. Now, if you request an actuarial certificate for the 2021-22 year onwards, you've got choice. You can choose which of those 2 methods you use. You can choose whether you want to see 50% exempt on the certificate applying for the whole year, or whether you want to see 0 applying for the first 6 months, and then separately apply the 100% for the second 6 months. So that's the choice that is there for you and your clients to make from this point onwards. Now let's look at another example. So in this example, we start the year with an account-based pension in the fund, $90,000, and then part of the way through the year, halfway through the year, we get a contribution into the fund, and so there's a $10,000 accumulation balance. These are all very standard scenarios that I'm presenting to you, scenarios that I'm sure you come across with lots of your clients. So if we had prepared this actuarial certificate prior to 1617, the calculated ECPI would have been around about 95% exempt. You can see that it's about 100% in the first half, it's about 90% in the second half, on average about 95%. So we would have given you an ECPI of 95% that applied across the whole year. If we had prepared an actuarial certificate for the 1718 to 2021 years, we would have said 90% exempt. For the first half of the year, the assets were segregated. So that doesn't get taken into account in our calculations. You can still claim 100% ECPI. You just won't see it on the actuarial certificate. For the second year, second half, you can see 90,000 account-based pension, 10,000 accumulation. You don't need to be an actuary to work out that the ECPI for the second half will be 90%. Okay, so and that's what we would show on the actuarial certificate. And now you could choose which of those 2 methods you use. Okay, so I hope you're all getting the hang of this, on how this works now. Okay, we've got a couple of questions. I'm just going to take those. Does the choice you make in this year lock in your future year's choices? great question, Owen. And the answer is no, it doesn't. So you can choose every year what you want to do for that year. And there's no Part 4A here that applies, which says that you're expected to make the same choice over and over again. It's not like segregation. The ATO doesn't like to see funds choosing to segregate assets. So choosing to allocate a particular asset, let's say a property, to the pension accounts this year, and then next year we'll unsegregate, and then the next year we'll allocate the property to the pension accounts again. The ATO does not like to see that, but they have no problem with you making a different choice every year. So each year you can choose whatever is going to give your clients the best tax outcome. Okay, now we have another question from Ben. Would that situation mentioned with accumulation then ABP for 50%, wouldn't you actually not need to get an actuarial certificate as this first period is 0 and the second is fully segregated? I'll just go back to the slide that Ben is referring to here. It's this slide. And Ben, you are 100% right. You wouldn't need to get an actuarial certificate here because the ECPI is showing 0. I'm just showing this just for illustration purposes because I think the mathematics is easy when you do it this way. If I started introducing different numbers, it makes the mathematics more complex, but you're 100% right. You wouldn't need to get an actuarial certificate. Okay. Next question from Sachi. From 2122, can we have question for choices while applying for actuary? Yes, so Sachi, later on in the presentation, I'm going to talk about the mechanics of how you make this choice. Okay, so stay tuned for that. Anthony, are the certificates going to show both results and the trustee choices? The answer, I can only speak on behalf of Lime Actuarial, and in relation to the trustee choices. In fact, rather than answer this question now, I'm going to address this later on in the presentation. So let me answer that later. And if you don't feel I've answered it by the end, feel free to ask the question again. But I think that you will be satisfied with the response. And Vicky is asking me, Vicky says she's not clear on where the 95 and the 90% are from. Would you please repeat this again? Okay. And Vicky's also said in example 1, why the percentage is 0 in 17, 18 to 2021. Okay, what I'll do, I'll go through this one more time. And Vicky, if you're still not clear after that, it might be best that we catch up offline. And I know you had another question earlier that I haven't answered yet either, and we can address that. But I do need to move on. In fact, Vicky, that's what I'm going to do. I'm going to address all of this I'm going to come back to all of this at the end because I do want to move on, and otherwise we'll run out of time, and I'll address all of this with you at the end. If there's lots of other people that have the same question as Vicky and you didn't follow where the 90, the 95% came from and so on, I'll go through all of that at the end. Okay. Okay, so now we're talking about which SMSFs are allowed to make this choice, because not every SMSF is allowed to. And it all depends on what period of the year the assets are segregated for. So if they're segregated for all of the year, then you must use the segregated approach. That means you don't get an actuarial certificate. You just calculate 100% ECPI. Okay, so I know there's a reasonable number of funds that have 100% ECPI, and where that's the case, you don't need an actuarial certificate. Puts me out of business, but that's okay. And you just assume 100% ECPI and you move forward from there. If the assets are segregated for part of the year, then you can use this choice method. And if the assets are segregated for none of the year, so that could be, for example, you have both an accumulation and a pension balance throughout the year, then you must use the proportionate method. Okay. That brings us to the next part of the presentation, which is looking at disregarded small fund assets. Now, let's just see if we have had any more questions. No, we haven't. No, we haven't. Vicky, you've said all good. That's great. We'll come back to that at the end. Okay, disregarded small fund assets. What are they and how do they work? Okay. So this is a new section of legislation that came in 2017, 1st of July 2017. And under this section of legislation, it's quite complicated to read it, but this is basically how it's summarised. Assets are disregarded if on the previous 30 June, so at the beginning of this year, one or more members had, and this includes external superannuation funds. So if your SMSF has a member who also has a balance in an industry fund or a corporate fund or a retail fund or a government fund or even in another SMSF, you have to include all of those balances together. If that member had a total superannuation balance of over $1.6 million and a retirement income stream, then the assets in the fund are disregarded small fund assets. And you'll note this threshold of $1.6 million. It's not a typo. Yes, I know the transfer balance cap threshold for many members has now gone up to $1.7 million, but this is a different threshold. It just happens to be the same number as the original transfer balance cap threshold. Okay, so this is still $1.6 million. It doesn't increase with inflation. Okay, so if you've got a member that had a big balance and part of that balance was, or a big balance across all their funds together, and part of that balance was in a pension, then you have disregarded small fund assets. And what does that mean? It means that the fund is not allowed to use the segregated method. So let's have a look at this example. So here we have a fund, starts the year with an account-based pension balance of $1.8 million. This is for just one member, by the way. So this member has more than a $1.6 million balance at the start of the year. And therefore, the assets are considered to be disregarded small fund assets. Okay. And then there's an accumulation balance that might have come about from perhaps a non-concessional contribution using the bring forward rule, or perhaps a downsizer property contribution, maybe even a small business CGT contribution, whatever it is, they've now got $200,000 in accumulation, okay? Total $2 million. So how would we calculate ECPI here? So the first thing to see is because of the assets being disregarded small fund assets, the assets are considered to be unsegregated for the entire year. Okay, you're not allowed to segregate. So up until 1617, we would have said 95% exempt here, similar to the earlier example that we looked at. So it's 100% in pension for the first half of the year, it's 90% for the second half, so on average about 95% in pension across the whole year. From 1718 to 2021, you're not allowed to use the segregated method here. So you must use the proportionate method and you'll get the same result, 95% exempt. And now there's no choice here because we have disregarded small fund assets. Okay, so no choice. Once again, we're going to get 95% exempt. Okay, let's look at our next example. we have in this fund only one balance for one member. It's an account-based pension, $2 million. Okay. So all in pension throughout the year, and it's more than $1.6 million. So this is where we've seen a change. Up until 2016-17, there was no concept of a disregarded small fund asset, and therefore there was no actuarial certificate required. You could just assume 100% ECPI in this situation by segregating all of the assets. From 17-18 until 2021, this was considered to be a disregarded small fund asset, and you needed an actuarial certificate. Even though blind Freddie could see that the ECPI would be 100%, you still needed to get an actuarial certificate. Now, I think sanity has prevailed here, and Treasury has introduced legislation that's been passed by Parliament that says that in this scenario, even though there's more than $1.6 million in the member's balance and it's in a pension, because it's all in pension, you don't need an actuary to tell you that 100% of the income should be exempt from tax. Okay, so in this scenario, no longer requirement from an actuarial certificate. Okay, and that's because the fund would have had disregarded small fund assets. This is the way the legislation's worded. The fund would have had disregarded small fund assets, but because the balances are all in retirement, they're not considered to be disregarded small fund assets. Okay, let's take a couple of questions. Ina, what if there is no accumulation period within the $1.8 million? Is it still segregated? Let's go back to the slide that I think you might have been referring to. Okay, so I think I've answered your question with the next slide, and you would have posed your question before I put this slide up. I think that's what you're asking, was this scenario here, and hopefully therefore I've answered it. If I haven't, then feel free to ask the question again and just maybe add a little bit more context. Danny, if the fund is unsegregated and the taxable income of the fund is a loss without any actuarial certificate, then there's no requirement to obtain a certificate. So, Danny, that is largely correct. So you don't have to get an actuarial certificate. If you have losses in the fund, then yeah, no need for an actuarial certificate. But just keep a couple of things in mind, and that is you need to separate the capital gains from the income. So you might have your income, such as your rent and interest and dividends and so on, might be less than your expenses, but you might have a big capital gain. Or it could go the other way. You might not have any capital gains. You might only have capital losses, but you might have a lot of rent and dividends, and they might exceed the expenses. So, but if you've got losses everywhere across the fund, then that's right. There's no requirement for an actuarial certificate. The other comment I'd make is if you're looking at claiming any deductions on expenses, you may want the ECPI percentage for that purpose as well. And I'm going to go into that in more detail at the end because of the question we had right back at the beginning relating to the allocation of expenses. So stay tuned for that when I go into that at the end. Okay, a question from Tanya. Did you mean 95% ECPI covering the whole year for 2022 in the last example? Yes, that is exactly what I meant, Tanya. The 95% covers the whole year in this example, the slide you can see in front of you. And that's because you're not allowed to segregate assets when you have disregarded small fund assets. So when you've got a member with more than $1.6 million total superannuation balance, and part of that balance is in pension, you can't segregate assets. You have to use the proportionate method for the entire year, which puts us back in the pre-2016-17 scenario. Okay. Okay, and then Peter's asked me a question with the example for $2 million, how do you allocate expenses? I'm going to come back to expense allocation right at the end because it's a little bit outside the scope of this webinar. Okay, let's move on. So now we're going to get into what I think is the most important part of today's webinar. The tax implications. What's going to give you the best tax outcome? Which choice is going to give you the best tax outcome? So here's an example for you. This is slightly different to the earlier examples. In the past, I was talking about the size of balances. Here we are looking at the amount of income that is earned by the fund in the two halves of the year. So this example 5A, we have an accumulation account for the first half of the year and an account-based pension account for the second half of the year, with $50,000 of income earned in each half. Okay, the important thing here being that the income is evenly spread across the year. So let's have a look at what the tax calculation would look like under the two different calculation methods. So if we use the proportionate method, this is the method where we calculate ECPI based across the entire year. We have income of $100,000 over the year. 50% of that is exempt. So the actuary has calculated, that's me, I've calculated that the ECPI is 50%, and that's because for about half the year, we're in accumulation, and for about half the year, we're in pension. Okay, so we've got income of $100,000. If it was all taxable at 15%, there would be $15,000 of tax to pay, but it's not. We can halve that because half the income is exempt. So we have to pay tax here of $7,500. Okay, I hope that you will follow the mathematics there. Let's look at the alternate approach, the segregated approach. So for the first half of the year, now we need to split the year up into the two parts. For the first half of the year, we had $50,000 of income. Now, because it is all in accumulation, the ECPI percentage calculated here is 0. As Ben correctly pointed out earlier, you wouldn't need an actuarial certificate, but if you did get one, it would show 0. And so all that income is taxable, 15% on $50,000. You have to pay tax of $7,500 for that first half of the year. Now let's look at the second half. So here we have $50,000 of income, but it's all exempt because the assets are segregated for this second half. All of the income is exempt, so there's no tax to pay. So if we add up the tax for the second half of the year and the first half of the year, the total is $7,500. You'll see that it exactly matches the tax under the proportionate method. So it doesn't matter in this scenario which method we use, they give the same tax outcome. And that is because the income is earned evenly throughout the year. Okay, so I hope that scenario makes sense. We've had a couple of questions, so let me just address those. Okay, a question from Simon. What is 100% pension assets in SMSF and say $200,000 in accumulation in an industry fund, do they need an actuarial certificate? I believe they still have 100% in SMSF, the industry fund super pay their tax. Yes, Simon, that's correct. So when we prepare our actuarial certificates, we only calculate the tax for the SMSF itself. The industry fund will do its own calculation for how much tax the members of the industry fund have to pay. And if a member is in both, the industry fund pays the tax relating to the industry fund and the SMSF pays the tax relating to the SMSF. The only reason we need to know the balances in other funds is to determine whether we have disregarded small fund assets or not. In other words, is the total superannuation balance more than $1.6 million, and is part of that in a retirement income stream? Paul, if you have already pension balance of $1.8 million and also an accumulation account, then nothing changes for financial year 22. Yeah, that's correct. Nothing's changed between 21 and 22. I just wanted to explain how that worked. Okay, and then Vicky has asked, if the income is not even, would you please let us see the difference? Oh, gee, Vicky. The good news is I just happened to have a slide on this. So let's move on to that slide. Perfect timing of your question. In fact, I've got more than one slide on it. So this is a very similar example, except this time, all of the income is in the first half of the year. So if we use the proportionate method, it's the same calculation as last time, as example 5A. The income across the whole year is $100,000. Half of it's exempt, and the tax is $7,500. Exactly the same calculation that we did earlier. Let's look at the calculation, though, now for the segregated method. So in the first half of the year, we have $100,000 of income. None of it is exempt because it's all in accumulation. And so we pay $15,000 of tax. Second half, there's no income. If there was income, it would be 100% exempt, but that's academic because there is no income. And so therefore there's no tax payable. So if we add them together, we would have to pay $15,000 of tax in the year if we used the segregated method. So here, clearly, the proportionate method is the better method. Okay? In this scenario, we want to use the proportionate method. Okay, and that's because we've got a lot of income up front in the first part of the year, and we want to use some of the benefit of having the account-based pension in the second half of the year. So we can only do that by spreading our calculation across the year. And that's what the proportionate method is doing. Okay. Now let's look at another example. This example is the opposite. This time we have all of the income in the back half of the year. So proportionate calculation is the same as the previous one. You should all be really good at that now, so I won't go through it again. The tax is $7,500. The segregated method, first half of the year. There's no income and therefore no tax. Second half of the year, there's 100,000 of income. It's all exempt. And so the tax is zero. So once again here, you don't need to be an actuary to work out that the segregated method is going to give you a better outcome because we can align the timing of the income with having everything in account-based pension. Okay? So Vicky, I hope that answers your question. We've got a couple more questions now. Let me answer those. Ivan, if an SMSF has one member with a total super balance of say $1.65 million and a TRBA. And I think that means transfer balance account with the index of $1.2 million. Does the $1.7 million apply to the disregarded small fund assets? And he needs to get an actuary certificate. Assume the member is only in the one fund, receives a retirement pension for it, and has contributions that go to an accumulation account. Gee, this sounds like a sophisticated question here, Ivan. So the transfer balance account and the threshold there for the transfer balance cap is completely independent of what we are talking about here in relation to disregarded small fund assets. The two have absolutely nothing to do with each other. And it's unfortunate that the original thresholds were both set at $1.6 million because that's created confusion because they both happen to be the same number, but they've got nothing to do with each other whatsoever. So we don't need to look at the transfer balance account. We only need to look at whether the amount of total superannuation balance is more or less than $1.6 million. I hope I've answered your question then, Ivan. I may not have, and if I haven't, feel free to ask a follow-up. Simon, in that sense, the member has, say, $1.3 million in pension, SMSF, and $400,000 in an industry fund. Doesn't she need an actuarial certificate from 2022? Am I correct? Yes, Simon, you are. Sorry, no. So, Simon, the answer to your question comes back to this slide. Back to this one. So 2021 and earlier, this would have been considered disregarded small fund assets and you would have needed an actuarial certificate. But from 2022 onwards, no longer need an actuarial certificate. Okay, Robert, do you have any examples as to the implications for exempt TRIS accounts? Okay, so let's come back to this slide here. I've shown this example and all of these examples using accumulation and account-based pensions. So let's talk about TRISs. So when you start a TRIS, the income is taxable. It's treated the same way as accumulation. And then when the member reaches the age of 65 or retirement, when they release or when they achieve a condition of release, the TRIS, it actually remains a TRIS. It's the same pension, but it becomes a retirement income stream. And from tax purposes, it's treated the same way as an account-based pension. So I've shown this as accumulation and account-based pension. You could equally have an accumulation balance and a retirement TRIS, and it would be treated the same way as in here. Or you could have a non-retirement TRIS, which is in the light blue, and a retirement TRIS in the dark blue. They will need to be two different members. You can't have, well, it's very, very unlikely that you would have a retirement and a non-retirement TRIS in the fund at the same time. But yeah, any non-retirement TRIS, same as the accumulation in the light blue. Any retirement TRIS, same as the account-based pension in the dark blue. Okay, question from Rosemary. In ordering an actuarial certificate, do we need to decide on which method we want first, or will the certificates list the options? Okay, Rosemary, good question. I'm going to come back to that in the next section, if that's okay. Peter, with example 5C, does the actuary tell us which method to use? Does the actuary provide both? Peter, great question. As with Rosemary's question, I'm going to answer that one as well later on in the presentation. Vicky, if we look at 5C, if we choose the segregated method, we'll not need an actuarial certificate when we then manually segregate the assets in BGL. Is that right? Okay, let me just go back to 5C. Okay, if we choose the segregated method, you don't need an actuarial certificate. That is correct. That's right. You don't need an actuarial certificate to do that, but you can still do it. You can still do the segregated method. You won't need an actuarial certificate. Not good for my business, but good for your clients. So that's what you should do if that's the scenario. Okay, that answers it. Thanks. Okay, Ivan, great. I'm glad I answered your question. Vicky, as with the new changes, does Lime provide the estimate percentage before we pay the fee? Yes, we do. Subject to which method you've chosen. Okay. Okay, and then Michael, who sent me a question last week, says that I've answered his question. That's great, Michael. Thank you. I'm going to pose your question anyway, because there were a few different parts to your question. I'm going to run through them at the end of the webinar anyway. But I'm glad I've answered them, or at least answered the part that you were most interested in. Okay, so I'm just going to run a quick poll here, and I'm going to ask you, which method do you find more intuitive? The proportionate method or the segregated method? Which one do you find easier to work with and to explain to your clients if they ask you, or explain to your more junior staff members? Okay, I'll just give you a few more seconds to answer that. Okay, 3, 2, 1. Let's stop there. Okay, you should be able to see the results there. 2/3 of you think that the proportionate method is more intuitive, and 1/3 of you think the segregated method. I think the proportionate method is. I think if we had asked this question 5 years ago, that would have been 95/5. We've all got used to the segregated method now, and so we're more comfortable with it than we were. But I do believe the proportionate method is the more intuitive. But that's just my opinion, and I've only got one opinion out of the 284 participants in today's webinar. So that's just my view. Thank you for your feedback there. That's really helpful. And that's going to feed into the next section. So we'll come back to this example. It's an example I showed you previously, but I just want to point one thing out. So if you are entering data manually into our website, or any actuary's website for that matter, so if you're not using a data feed from, say, Class Super or BGL, whenever the fund balance moves from being segregated to unsegregated, we need to reset our calculations, and we will ask you for what the balances are at that time in accumulation at this point. Sorry, in pension, I should say, just prior to the accumulation balance starting. We'll ask you for those balances. Now, we don't need that information for the proportionate method, but we do need it for the segregated method. So to me, it's just another benefit of the proportionate method that information isn't required for our calculation. And if you've got multiple times when accumulation balances are starting and stopping, maybe like a contribution, then a new pension, another contribution, another new pension, then we'd need to ask for those balances 4 times during the year. So it's just another advantage to me of using the proportionate method, but you'll have whichever one you feel you're more comfortable with. So one of the questions we had earlier is, I think what you're really getting to is, what's the preferred option? Which option should I use? And there's probably many of you sitting there thinking, well, I use, let's say, Class Super. I'm sure I pay Class Super $250 for every fund that I have on there. Surely for the amount I pay them, they will tell me which option I should be using. Well, I'm sorry to report that if you use Class Super, they will not be recommending the preferred option to you. And so there's probably quite a few of you now thinking, oh, thank God I use BGL. I don't use Class, I use BGL 360. I don't pay them quite as much, but surely they will tell me what the preferred option is. Well, I'm sorry to say that BGL 360 will also not be recommending the preferred option. And so now I guess you're thinking, well, surely Greg from Lime Actuarial is going to tell me what the preferred option is. And once again, I'm sorry to disappoint you, but not only Lime Actuarial, but as far as I know, none of the actuaries will be recommending the preferred option. And it's not because we don't want to, it's because we would need a whole lot of additional information around tax losses and the timing of income being earned and timing of lots of other transactions and perhaps expenses as well, that we'd have to, for those of you who are doing this manually, you'd have to enter probably 3 or 4 or 5 times the volume of data that you enter now. And Class Super and BGL 360 would need to update all of their data feeds and create so much more data, which they, I don't believe, were wanting to do. And therefore, we are not in a position where we are able to recommend the preferred option to you, okay? So it's something you're going to need to work out yourselves. So I know what some accountants have done is they've requested the certificate twice, once using the segregated method and once using the proportionate method, and they've seen which one gives the better result. And you're allowed to do that. There's nothing to stop you doing that. And of course, Lime Actuarial lets you create an unlimited number of actuarial certificates. So you can do that if that's what you would like to do. But I thought what I would do today is I'd give you a rule of thumb. What do I think you should do that will get you through 95% of cases? So to start off, if the income is earned evenly throughout the year, I prefer the proportionate method. And as I said, I think it's more intuitive, and 2/3 of you on the call think it's more intuitive as well. So I would suggest that that's the way you go if the income is earned evenly throughout the year, which 95% of the time will be the case. But it won't always be the case. If you have a large capital loss, you'll probably also want to use the proportionate method in order to retain that loss and carry it forward into future years. If you use the segregated method, you won't be able to. And then finally, if the income is front-ended or back-ended, then you want to try and align having higher ECPI percentage, not just what appears on the certificate, but higher percentage overall at the time when that higher amount of income is earned. And so this would be, for example, if you've got a large capital gain, selling a property, selling a portfolio of shares when the market's been strong, or it might be for a fund that, let's say, has term deposits that all mature at a particular time of the year. They were, let's say, 1 year or 3 year or 5 year term deposits, so all the income comes in a certain month. So if that's the situation, you want to try and align the timing of the higher ECPI with the higher income. And looking at these rules of thumb, I think in most cases you'll be able to work out just from thinking which method is going to be the best method for you, the proportional or the segregated, without having to get 2 actuarial certificates. So that's how the tax works. And now I want to talk about the mechanics of exercising the choice. But before I do, we'll just go back to our questions. Okay, so got a comment here from Vicky. If the estimated percentage will be provided before we pay, it is not good for accounting business if the accountant finally chooses the segregated method. I'm not sure exactly what you mean by that, Vicky. Certainly with Lime Actuarial, you can get as many draft percentages as you want for different scenarios, or you can get as many final certificates as you want for different scenarios as well. And I'm not sure what the downside is for the accounting business. You've got the flexibility to request either or both of, use either or both of those methods. Owen has said segregated. Okay, I've got a few people saying segregated and proportionate. I think you're responding there to the poll that we did. And Simon said, is not very clear about my answer. I'm not sure which question this is referring to, Simon. ATO, and then he's referred to a reference, QC 66640, allow the fund to use the segregated method, remove the requirements to obtain actuarial certificate for disregarded small fund assets from income year 21-22. I'm not sure exactly what you're referring to there, Simon, but you might want to elaborate in the comments there, in the questions. Okay, now we're going to talk about exercising your choice. Okay, so first of all, when do you have to make this choice? So if you choose to segregate assets, if you choose to allocate a particular property or a share portfolio to pension and other assets to accumulation, for example, you have to make that choice in advance. You have to make it at the beginning of the financial year, but not so for choosing your calculation method. You can do this at any time, as long as it's done before you lodge your annual return. And in practical terms, you have to do it before you get your actuarial certificate, because we need to know which choice you're making. Documenting your choice. So the default is the segregated method. If you don't document anything, it is assumed that you are using the segregated method. So if you're using the proportionate method, I would encourage you to ask the trustees to sign a very simple minute that says something like this. It doesn't have to be this exact wording, but the trustees of the ABC Super Fund have elected to use the proportionate method for the purpose of calculating ECPI in the 21-22 financial year. And don't forget to change the ABC Super Fund to the actual name of the fund. I've seen funds before where they just copy and paste the wording like this and they forget to tailor it to the fund, or they use the wording from the previous fund they did for a different client the week before. That's never a good look. So make sure that you actually update that. Okay, we're on to our next poll. How do you, and you'll be able to answer this, you don't need to put it in the Q&A. How do you request your actuarial certificates? Do you use a data feed through BGL 360 or Class Super? Do you enter your data manually into the Lime website, or do you use some other method? Okay, here we go. Okay, I'll give you a few more seconds there. 3, 2, 1. We'll finish there. Great, so we've got a good cross section. First 3, approximately a third, slight weighting towards Class Super. That doesn't surprise me. We've been integrated with Class for a bit longer than we've been integrated with BGL 360. So I'll stop sharing that now, but that's useful for me as we go through the next section. So for those of you that use BGL, you'd be familiar with something that looks a bit like this. And BGL operates very differently to Class in this respect. So in BGL, part of the way through requesting the actuarial certificate, and you're going to see this box pop up. So this will pop up every time you request an actuarial certificate, that certain criteria apply, that you'd be able to, so you're part of the way through the certificate and this pops up. And I'm just going to hone in, I'm going to zoom in on this section in the red so you can see it a bit more clearly. The first question is, please confirm the fund's eligibility to use the segregated method. This is an existing question that already appears when you request actuarial certificates through BGL. So nothing's changed there. But then there's a new question underneath. Choose the ECPI calculation method. And the first one is only use the proportionate method. And the second one is to use both. To use deemed segregation for the periods where the assets are segregated. So you're splitting the year into the two parts. Okay. So all you have to do, the only additional step for BGL is to answer this second question. Okay. And it will only appear if you've said in the first question that the fund is eligible for segregation. That is, you don't have any members with disregarded small fund assets. Okay, so it's a very simple process in BGL. Now, if you use class, you probably hope that you have an equally simple process. I'm sorry to say, I don't think so. So we start off with this screen where we have our fund policies. So you'll see this section down here. We have the fund policies, okay, in the red. Okay, so what you'll need is you need to have a fund policy from 1 July 21 onwards, or from a later date onwards, but from at least 1 July 21. And then we need to edit the most recent fund policy, or we need to have a new fund policy, one of those, depending on when the most recent fund policy was there. That's going to bring us to this screen, okay? And on this screen, we have here the ability to elect our ECPI calculation method. What I want to point out here, though, is that this is not part of the process of requesting an actuarial certificate. You need to go back into all of the fund settings in order to get to this stage. So it's not at an intuitive point in the overall process. And this option is only going to appear if the fund is eligible for segregation and if it has both a period of segregation and a period of unsegregation. Okay, so you won't always be able to make this selection. Once you make this selection, it will remain in place as the default until you change it in the, let's say, the following year. So the problem is, if in class, if you wanted to go and set the proportionate method as the default for all your funds, you can't do that. You have to do them one at a time, but not even for all the funds, only for the funds that tick certain boxes. And then in a year's time, if you wanted to come up with a list of which method you're using as the default for which fund, you can't do that either. So you have to go through them one at a time again. I find the process in class to be quite cumbersome, and I am going to be giving this feedback to class as well. To be fair to them, they had to put this in place in a short space of time, and I'm sure they did the best that they could with the limited timing and resources that they had, but I do think that they can improve on this. So once you've made this selection in class, we then come to this screen here, where we have period updates, and we have to roll back the period update back to the last period where there were segregated assets. And those of you who use class will be familiar with that rollback process. And then finally, we request the actuarial certificate. So there's a few extra steps there in class that we don't have in BGL. For those of you that request the certificate manually through the Lime Actuarial website, we've made it very easy. Just like BGL, we've introduced this as part of the process of requesting the certificate each time. And we just ask you a simple question. Please select the preferred method, the proportionate method, or the segregated method. And then there's an information icon. If you want to read more about what those methods are, then we explain that further. And you'll see up the top, we've introduced an additional step to do this between step 2 and step 3. We've called this step 2B. So that's what we do at Lime Actuarial. We've tried to make that as simple as possible, as we try to make everything as simple as possible. This is what the certificates will look like. So we've put the two side by side. The one on the left is using the proportionate method, the one on the right using the segregated method. We've just added this extra line into our appendix so you can remind yourself which method you have used. And if you're using the segregated method, you'll have this extra text on the bottom right-hand side. And that text, you might be familiar with it. We've had it on all of our certificates since 2017-18. If you're using the proportionate method, the dates when the assets were segregated isn't relevant, so we don't include that text. So that covers off all of the content today. I'm just going to come back to this quote because I look at all this, and Treasury made these changes in order to simplify things. And in my view, they've actually made things a lot more complex than they were before. I would prefer they would have gone back to the way it was prior to 17-18, or second to that, left it the way it was for last year. I think they've just added more and more complexity, but I'm sure it's not the first time that Treasury has done that when they've made rules. I am going to hang on to answer some more questions in a moment. I've got some more questions that have already been asked, and please feel free to continue asking questions. And I'll stay on for as long as I need to in order to answer all of your questions. For those of you who are regular clients of Lime Actuarial, thank you very much for supporting us. And for those of you who are not, we'd love to be able to work with you, and feel free to reach out to me if you've got any questions around actuarial certificates, ECPI, SMSFs in general. There are my contact details, and always happy to chat to you or respond to any emails that you might have. So I am now going to answer all the questions that we have. Okay, Vicky asked, do we charge twice or a few times if we want to try a few times to see the difference? You can get as many replacement certificates as you like with Lime Actuarial, and we'll only charge you once, okay? The process to do that, if you're using Class Super or BGL 360, you start the process again from there. Make sure you refresh the data by starting right from the very beginning of the process, and then just follow the same process as you did the previous time. And we'll recognise automatically that it's a replacement certificate. You don't need to enter invoice numbers or do any reconciliations. We'll do all of the hard work for you. And you can do that as many times as you want. I know some actuaries only give maybe 1 or 2 free replacements. We give as many as you want. Can we please be emailed a copy of your presentation? I will be distributing the recording. I'll probably get that to you by the end of next week. Might just need to do a little bit of editing on that. We'll aim to send that to you by the end of next week. Okay. Next question from Bill. I assume no written choice is required where there are no segregated pension assets. Correct. Yeah, that's correct. You don't need to make a choice if there's no choice to be made. That's correct, if you don't have a choice. Please make the screen big so we can see properly. I'm not sure why you haven't been able to see properly there, Tanya. I'm not sure if that's something at our end or not. Possibly a little bit academic now with that comment. But I did have other people who were looking at this, checking to make sure we didn't have any technical issues. So hopefully that's something that hasn't applied to the majority of the listeners. Documenting of choice of trustees, ECPI, would CLASS or BGL have added into one of their annual minutes? That's a really good question, Rumnik. And that's really a question for CLASS and BGL. I dare say they probably will, and they might not have done so yet. But that's something that you'll just have to check with CLASS and with BGL. And if they haven't done so, you should reach out to them and you should ask them to do so, because it's pretty easy for them to do and it'll make your lives easier as well. Rosemary, we all live in fear when the government mentions the word simple. Yes, don't we do that? That's exactly right. There's nothing simple when it comes to government. Will we get a copy of the presentation slides? So as I said, I'll send out the recording. Thank you, Greg. Lovely presentation as usual. Clearly explained concepts. Thank you, Basil. That's very kind of you. The checks in the mail. Vicky, great slides and webinars. Thank you so much, Greg. My pleasure. I've got a thank you. Thank you. It was informative. Francis, thank you for attending the webinar. You're a wonderful and accommodating presenter. Appreciate your work. Thank you. Oh, sorry, not Francis. Francie. Thank you, Francie. Appreciate you attending this morning and thanks for your comments. I've got a question here. Can't find the option to choose the segregated and proportionate method in CLASS. Can you show us again? Look, there's a whole lot of reasons why that might be. It could be because your fund is not eligible to choose. I found it really difficult to find this in CLASS. The person that's asked that question has asked it anonymously. And what I'm going to suggest that you do is send me an email. We took some screenshots and maybe I can forward the screenshots to you of the process to do that. Thank you, Joanne, for your comments. Vicky, how to refresh the data. You need to go right back to the very beginning of the actuarial certificate process as though you've not requested an actuarial certificate previously. You don't need to manually type anything in, but you need to go right back to the very beginning. Do I email out the hard copy? Yeah, I can send out the PDF version of the slides as well, if that would be helpful for everybody. Each user moves the vertical bar to make the slides bigger or smaller. Thank you, John, for that comment. That would be in relation to the earlier comment that you couldn't, that the slides were too small on the screen. A couple more responses on that. How long will Lime take to issue the actuarial certificate after we pay and order the actuarial certificate? You don't need to pay. You do eventually, of course, but whether you've paid or not, we will issue the actuarial certificate in around about 5 seconds, 98% of the time. Sometimes we like to review it manually ourselves. Getting lots of thank yous here. And appreciate how very simple it is to load information onto your website to get a certificate. Thank you for that feedback, John. We get that feedback a lot. It's always great to hear. If a member in accumulation, this is from Carol, if a member in accumulation leaves the fund part of the way through the year, leaving one member who is in pension, does the fund need an actuarial certificate at that time and at the end of the year? You don't need an actuarial certificate. What you may want is an estimate of the ECPI so you can accurately calculate the balance. And if that's the case, then we can give you that estimate at the time. We can help you with that. We won't charge you for that, but you don't need the certificate itself until the end of the year. Okay. And is there a certificate to say that you attended the webinar? Yes, so we will send you, if you have attended, we'll take a record of who's attended and who hasn't, and we'll send you a confirmation of you attending. Now, I'm going to come back to a question that was submitted by Mike prior to the webinar. Thank you very much for organising. I have 4 segregated accounts. There's quite a lot of aspects of this question that Mike has asked, and so I thought it would be a really good question to cover off. I have 4 segregated accounts in my 2-member SMSF. 2 are in the pension phase and 2 are in the accumulation phase, although the 4 accounts are segregated for investment purposes. So the first thing that Mike is saying here is he uses segregation for investment purposes to allocate income between the members, okay? But he doesn't use segregation to allocate income for tax purposes between pension and accumulation. And that's entirely legitimate. It's a good strategy. It's got its place for the right types of funds, especially when you've got, say, a father and a mother and a daughter and a son, all in the one fund. And the parents have different risk tolerance to the children, okay? But the parents might have an accumulation account as well. And so they want their assets with less volatility. They want the income from those to go to all of their accounts, their pension and accumulation accounts. So this is not segregation for tax purposes. It's segregation for member investment allocation purposes. So yeah, that's perfectly legitimate. You can do that, Mike. And then he said he sees a real tax advantage of switching to a segregated ECPI method. So now he wants to start segregating for tax purposes by ensuring that those assets with high tax liabilities, capital gains tax, distribution and dividends are mainly located in the pension phase accounts, and other low yielding assets are mainly accumulation phase accounts. Under the new regime, I understand that I can now elect to use a segregated method, but I must have separate bank accounts for each of the accumulation accounts. So first of all, you've been able to do this for years. This is not a new thing. You could have done this at any time, as far as I know, in the past, as far back as I can remember. You could have segregated your assets between the pension accounts and the accumulation accounts. So there's nothing new there. And if you do that, if you have all of the assets segregated to pension, some assets segregated to pension and others segregated to accumulation, you don't need an actuarial certificate. But you can only do that if you don't have disregarded small fund assets in the fund. So if, in other words, if all of the members have a balance of less than $1.6 million, by and large. And then he said, he's asked about different bank accounts. So you don't need to have different bank accounts if you are choosing to segregate assets. You can have one bank account that sits across the whole fund. But within that bank account, you need to be really careful. You need to make sure that within that account, you can track how much of the bank account belongs to pension and how much of it belongs to accumulation. And for example, when interest gets earned, you need to allocate notionally part of that interest to pension and part to accumulation. And you also need to be really careful whenever you segregate by election. You need to think about when there's an expense, who does that expense belong to? Does it belong to the pension members or does it belong to the accumulation members? What if you pay tax and you've got franking credits, or if you pay PAYG tax? Then how does that work? And how much of that comes out of the pension accounts and how much out of the accumulation accounts? It's really hard to get it right. And I think you should only use segregation by election if there's going to be really significant benefits in doing so. Because if you were as the accountant are going to do this properly, it's going to take up a lot of your time, and you should be charging your clients for that time. So I hope, and then the final question Mike has asked is, do I need to elect this method in advance? Yes, you do need to elect segregation in advance. You can't just wait till the end of the year, as you could with the choice that we were discussing today. And then we had another question earlier specifically in relation to expenses, and why is it that the expense allocations that are calculated by Class Super and BGL are different from what we show in the actuarial certificate. So this is because there are two methods to calculate the tax deduction and allocate the tax on expenses between pension and accumulation. You can use the actuarial certificate method, where you just take the percentage in the actuarial certificate, or you can use the statutory method, which is a completely different formula. And there is there's a tax ruling on this, and I'm just going to try and see if I can find quickly what that tax ruling is. My screen's probably gone a bit strange while I do that. In fact, you know what, it's going to take me too long to do that. What I'll do, rather than do that, I will, if anybody particularly wants to know what the tax ruling is, send me an email and I'll respond to you exactly what that tax ruling is. I think that's probably a better way to go, because I don't want to hold all of this up now. So we'll do that. Okay, let's see, next questions. Last questions from Peter. What was the second method called again? I assume you're referring to proportionate and segregated. I think that's what you're referring to. And then I've got a question from John, just confirming no certificate required if the fund has, say, 2 members and both in pension mode and balances for each less than $1.6 million. That's correct. Even if they did have balances of more than $1.6 million, if the entire fund is in pension, there's no actuarial certificate required. You can claim 100% ECPI without an actuarial certificate for the 2022 year and onwards. Okay, I think that answers all of our questions. Oh, there's always going to be another one. Great. We've had another question from Anusha. Anusha, the fund members are mum and daughter. Mum is in pension phase and the daughter is in accumulation. Total super balance of both members is more than $1.6 million. They maintain segregated assets for investment purposes and also for tax purposes. Do they still need to obtain an actuarial certificate? So Anusha, the answer is they are not allowed to segregate for tax purposes. They can segregate for allocating investment income between members. They are not allowed to segregate for tax purposes because the fund has disregarded small fund assets. And that's because the mum has more than $1.6 million and she has a pension balance, I'm assuming at the start of the year, or to be technically correct, the 30th of June from the end of the previous year. So that means segregated, disregarded small fund assets, can't segregate, have to be unsegregated, have to use a proportionate method, and you'll need an actuarial certificate in order to do that, because part of the fund is in pension and part of the fund is in accumulation. Thank you, Mary. Thank you, Mary. You've told me what the name of that tax ruling is on expenses. It is TR 93/17. So for those of you still on the call, we've still got 168 people. That's fantastic. Thanks for hanging around. And for those of you that were wondering what that ruling is, thank you very much to Mary, who has told us that that is tax ruling 93/17. So thank you for that. And so that's our last question. I'm just going to stay on for another minute and give you an opportunity to ask any further questions that you might have. And then if there's no more questions in a minute's time, then we're going to wrap up from there. For those of you that are still on, thank you very much once again. Really appreciate you attending today and staying right till the end. It is 12:30, which is our scheduled finishing time. So that's all very good timing. And we'd love to stay in touch. For those of you that we don't have as close a relationship with, we'd love to stay in touch and love to be able to help you with any of your actuarial needs going forward. And to our loyal and regular clients, thank you once again. We enjoy working with all of you. Thanks for your support. We don't have any more questions, so I think we're going to wrap up there. Thank you very much and have a great week.